My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends just trying to make a little money. My job is not just to entertain you, but to educate and teach you. So call me, 1-800-743-CNBC, or tweet me at Jim Cramer. Is this the calm before the calm? After still one more record-breaking month in the books, I keep thinking this market will win some converts, turning bears into bulls. That's not happening, though. With the Dow gaining 238 points today, S&P advancing 0.27%, but the Nasdaq declining 0.48%. We had to endure all that sell in May and go away nonsense last week as if nothing good has happened. Now we have tech rolling over, and I'm sure tomorrow there'll be chatter about how the market can't roar without FANG, my acronym for Facebook, Amazon, Apple, Netflix, and Google. Yes, once again, the obituaries will be written. How many times? We're going to be subjected to the usual bubble talk, hardware, software, electronic vehicles, of course, SPACs. You'll hear that none of these great earnings matter because we're at the peak. But that's the wrong way to look at things. In truth, this is once again a gigantic rotational market where there's not enough money to send all sectors up at once. Tech's had a huge run lately, while everything else is language except for fintech. Now it's tech's turn to cool, while other groups play catch-up. Do you know that that's been the pattern since the bottom last year? But the panda bears who control the narrative just won't acknowledge it. It's always rollover, 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 never talking about the next group to run. We're going to change that tonight. But before I get into today's action, I need to address Warren Buffett's concerns about individual stock picking, a theme I will examine again near the end of the show because I know it's so important to you, especially the younger members of the audience. Here's the thing. Stock picking did go out of style 20 years ago. This generation of investors has been taught that it's impossible to beat the market, so don't even try. Don't try to figure out which retailers are doing the best. Just go pick an index fund. The previous generation was taught a far different set of skills. How to pick stocks by combining curiosity with what you know and melding it with the study of the financials or whatever other information you come across. That's not the Warren Buffett method. It's the Peter Lynch method, named after the legendary manager of Fidelity's Magellan Fund. Lynch credited most of his success to something you can do, I can do, anyone can do: observing, studying, and taking action. He shows you how to do it in his seminal text, One Up on Wall Street. And it's still a living, breathing book. It's on Amazon, and it's not been destroyed or pulped. And the Lynch method has never been easier because you have more research tools at your disposal than ever. It's not like Google existed when the book came out in 1989. I respect Warren Buffett, but I'm always going to be a Peter Lynch guy. Even though he made his money running a mutual fund, he still felt compelled to teach people how to do it themselves. If you think about it, he's really teaching them how to compete against them. But thanks to the dot-com bust and the financial crisis, the Peter Lynch method lost a lot of its luster. Plus, it didn't help that the whole industry proselytized against owning individual stocks, with Warren Buffett leading the way. In the 90s, the conventional wisdom said that picking stocks was a great way to make money. These days, picking stocks is considered a mug's game. Anyone with half a brain knows you're supposed to put all your money in a nice, low-cost index fund. But you know where the truth is? The truth lies somewhere in between. If you don't want to put that much time and effort into managing your portfolio, parking your money in an index fund is absolutely the right way to go. But the index fund pushers got too far. Too far when they tell you that stock picking is a waste of time and money. Yeah, that's condescension. I think you can get better performance by picking individual stocks. The problem is you got to do more work. That's why I believe in a hybrid model. I don't share Buffett's contempt for home gamers who try to pick stocks, nor do I want you to go all in on individual stocks. That's why I've always suggested you put your retirement money in an index fund, but your discretionary mad money, hence the name of the show, in individual stocks. I don't want to discourage you from harnessing your powers of observation, and much of what I do is oriented around bringing stories to your attention so that you can do more homework yourselves. No contempt here, just support, which brings me to today's market. For months, I've been preaching that the economy is about to open up, and we're going to reach a tipping point where you have to own stocks that do well when the consumer's flush. Well, we're finally there. Maybe because cities like New York look like they're going to turn, or malls are beckoning. That means two things. One, we need to own stocks that benefit from consumer confidence. And two, we need the cash to buy these stocks. So what are people doing? Well, they're raising cash. They're selling anything that doesn't fit the reopening thesis, like tech, which is being used, I think, incorrectly because the money's going to come back to tech. But it's being used as a piggy bank to finance other investments, and I accept that. Now, I wish there were more than enough money to go around to justify owning both groups, but there simply isn't. And the current rotation is fueled by that lack of capital. Only so many sectors can win at the same time. Sure, stock ownership is at its highest level, but that doesn't provide the new ammunition needed to finance more buying. For those of you who think that you've already missed this move, because they've had tremendous runs, I'm aware of that, I want you to think again. We haven't even begun to convert the bears to this new bull thesis. So let me give you some ideas to chew on, observe, and make a choice about buying. Maybe you'll try some of this stuff on or go to these places, then go to Google, look for some stuff, go to our sites, you'll find things. First is Walmart. Now, this is the largest brick-and-mortar retailer in America. If we open and go out, wow, we're going to go to Walmart. It's still down 11 points from its high, perhaps because of so many stories about Walmart Plus being weaker. Really, ever since Mark Lowe retired in January. He's that guy from Jet.com, which Walmart acquired to reinvent its online business. Man's a genius. But I don't think he's essential. In truth, Walmart's doing great and about to do a whole lot better. Mine was packed this weekend. Second is Costco. Now, think about this. They're bringing back free samples, and food courts don't denigrate this one. Makes the comparisons versus last year just spectacular. Costco continues to open new stores, take more fees, save people money. What is not to like? I love it. Third is Lowe's. Now, unlike Target and Home Depot, which are amazing in themselves, Lowe's is still almost 10 points away from its high. Go to Lowe's like I did this weekend. See the action. Do you know that mine opened at 6 a.m. Sunday and closed at 10? You don't keep those hours unless you got a ton of business. You know what you see in the aisles of Lowe's? Well, how about appliances? How about tools? If you did a little digging, you'd know that there's a shortage of appliances. Go ask the home builders. Read the Whirlpool conference call. You'd know that tools are exploding when Stanley Black & Decker generated 48% growth, which is pretty darn shocking. We heard about it last week on the show. The stock was down that day. Talk about an opportunity. Fourth, we're opening up and we're dressing up. There aren't a lot of quality clothing stocks left, but the good ones are PVH, VF Corp, and my favorite, which is Ralph Lauren. I expect big sales this month. Oh, I still like RH, the operator formerly known as Restoration Hardware. I wish my wife would order fewer from there because, boy, how many chairs do you need around the fire pit? But it's an incredible run the stock has had. The stock doesn't have enough buy ratings on it. Finally, I believe in the lag trade, and that's L Brands, American Eagle Outfitters, and The Gap. Even as they've all had big runs, Matt Boss, the fabulous retail analyst from J.P. Morgan, coined the lag trade much lower. But it's only just dawning on people now, and the rest of the analyst community is going to have to follow suit. They have to upgrade. They have no choice. The bottom line, I don't mean to make it sound simple. If you want to invest like Peter Lynch, you need to actually visit these places or try things on, whatever sparks your curiosity, of course, after reading his book. But I think one or two of these reopening places go well with an index fund in your retirement account. And I'm not afraid to say it, even when highly respected figures like Warren Buffett act like stock picking is too dangerous for regular people like you. More on that later.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.